Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Hello friends, today's topic is operate or shut down, and it's part of management accounting. Friends, as you know, management accounting is the application of professional knowledge and skill in presentation and preparation of accounting information so as to assist in planning, decision making and controlling. It not only provides internal reporting to the managers but also compares performance for use in decision making before formulating major plans and policies. It refers to managerial processes and technologies that are focused on adding value to a firm through identification of opportunities, attaching effective use of resources, and thereby decision making on selection of the best course of action so as to achieve goals and solve business problems. Friends, all decisions are futuristic in nature. They involve a forecast of what the management thinks is likely to occur. However, one should not forget that the future is highly uncertain, and similarly business decisions are surrounded by uncertainty. Hence, there are chances of the prediction or decision taken may go wide of the mark. Friends, today we are going to talk about operate or shut down. Today's session is focusing on one of the various short-term decision-making situations, that is operate or shut down the plant. Why this situation arises? Sometimes due to low demand for its product, a firm continuously incurs losses. In such a situation, the firm thinks for eliminating costs, and to eliminate costs, it takes into account possibility of shutting down the plant temporarily till the demand picks up. To arrive at the decision, the firm should evaluate the situation with the help of differential cost analysis. Differential cost analysis means comparison of cost of shutting down the plant with the cost of operating the plant. So long as the firm is able to generate some contribution means difference between sales and variable cost, it should continue operating the plant. As fixed cost is unavoidable, they have to be incurred whether the firm operates the plant or shut down the plant. The firm may reduce fixed costs to some extent, and that will become our avoidable fixed costs. And here, avoidable fixed cost becomes relevant cost for decision making. Thus, this session will give insight whether to operate or shut down the plant temporarily so as to eliminate cost when there is a low demand for its product. Let's have a discussion in detail. As we have discussed earlier, a firm may face problem of low demand for its product continuously. As a result, it may incur losses for a certain period of time. To avoid loss, the firm may plan to think of elimination of cost, and to eliminate of cost, there will be first option before the company is shutting down the plant. Sometimes it may think the possibility of shutting down the plant temporarily till the demand picks up. However, there are some hidden dangers of shutting down the plant. When firm shut down the plant, there will be a loss of customers because customers will move to our competitors. There will be loss of trained, skilled and efficient employees also, because we have to relieve them because we are shutting down the plant. But when we restart the plant, there will be again expenses on recruitment and training and selection. There will be also expenses on advertisement and publicity to get the customers back from the competitors. This was the one option, shutting down the plant. The other option is operating the plant. Why to operate plant? Looking to the hidden dangers of shutting down the plant, it may think of operating the plant. By operating, it may avoid cost of shutting down the plant and cost of restarting the plant. Then the other question arises, what should be the minimum level of sales to operate? Minimum level of sales to operate is nothing, but still we are having to generate contribution. So, if we have contribution in our business, we should have a minimum level of sales to operate. Hence, the decision whether to operate or shut down is very crucial. To take the decision, we have to evaluate the situation with the help of differential cost analysis. In differential cost analysis, we compare the cost of shutting down the plant with the cost of operation of the plant. There are 3 steps in it. Step 1 is determination of avoidable fixed cost. Friends, all the fixed costs cannot be avoided. As you know, fixed costs are fixed. They have nature of fixed tendency. They cannot be avoided. However, the firm should make list of certain fixed costs which can be avoidable. So, if it shut down the plant, then certain costs can be avoided. So, fixed costs which can be considered as unavoidable, it has to be incurred whether the firm operates the plant or shut down the plant. But the firm should identify and make list of fixed expenses which can be avoided, and the avoidable fixed cost becomes relevant cost for decision making. Relevant cost means the cost which affects the decision making procedure. So, here the cost which can be avoided, the fixed cost which can be avoided is considered to be the relevant cost. This was our step number 1. Step 2 is comparison of avoidable fixed cost if the firm shut down the plant with the loss that is presently incurred by the company. So, here we are going to compare the fixed cost which can be avoided in case of shutdown and the loss which can be presently incurred. So, comparison means here avoidable fixed cost is less than loss, then we will shut down the plant. And if avoidable fixed cost is greater than loss, we continue to operate the plant. This was our step 2. And last step, third step is effect of avoidable fixed costs on the profit of the firm. To arrive at the decision, the firm should evaluate the situation with the help of differential cost analysis and effect of relevant cost. Relevant cost here is avoidable fixed cost on the profitability should be studied by the businessman. Let us take an example to have better understanding of the situation, that is to operate or shut down the plant. Friends, we are provided with profit and loss statement of D Limited. There are 3 informations given to us. Particular is the first column, second column is per unit information, and the third is total. First information which is provided to us is sales of the firm. At present, company is selling its product at ₹50 per unit, resulting into total sales of ₹30 lakhs. From that, variable cost has been deducted. Per unit variable cost is ₹40 per unit, and total variable cost is 24 lakhs. The difference is nothing but contribution. Contribution is ₹10 per unit, and total contribution we are having 6 lakhs. At present, fixed cost is 7,50,000, and the difference here we are having is loss of ₹1,50,000. So, at present, company incurs a loss of ₹1,50,000. We are given the other information. Additional information is about avoidable fixed costs. We can avoid fixed costs to the extent of ₹3,50,000. So, avoidable fixed cost is 3,50,000, and we are asked to suggest whether to operate or shut down the plant. Let us have a solution of it. Friends, as from the problem given to us, we are knowing due to low demand, there is presently a loss of ₹1,50,000 which is incurred by the company. There are 3 steps as we have discussed earlier. Let us first have a calculation for step number 1. Step number 1 is determination of avoidable fixed cost. Friends, avoidable fixed cost is directly given to us in the example itself. It is ₹3,50,000. So, there was no calculation required for step 1. It was directly given to us in the example. Now, second step is comparison of avoidable fixed costs if the firm shut down the plant. So, here our firm is going to shut down the plant or is thinking to shut down the plant. The avoidable fixed cost is 3,50,000 as per step number 1, with the loss currently incurred by the company. The loss which is currently incurred by the company is also given in the example. It is 1,50,000. Here we compare it. Avoidable fixed cost is 3,50,000, which is greater than loss of ₹1,50,000, and that's why the decision will be we should continue to operate the plant. We can conclude it as avoidable fixed cost is more than loss. It is advisable to operate the plant through elimination of fixed cost up to rupees 3,50,000 rather than shutting down the plant. The last step is step 3. Here we calculate effect of avoidable fixed cost on profitability with the help of differential cost analysis. Here differential cost analysis is used. We are going to compare here the present situation, and if we continue to operate the plant, as from step number 2 we have decided to operate the plant, so there will not be change in the sales. At present sales are 30 lakhs, so we are going to operate the plant, there will be sales of 30 lakhs. Variable cost is directly relating to the sales, so there will not be change in the sales. In present situation it is 24 lakhs, so it will be 24 lakhs if we continue to operate the plant. As a result, there will be no change in the contribution. Contribution will be 6 lakhs at present, even it will be 6 lakhs if we continue to operate. Only the difference is here fixed cost can be avoided. It can be avoided up to rupees 3,50,000. So presently it is 7,50,000, and if we continue to operate by avoiding fixed costs up to rupees 3,50,000, our present fixed cost is rupees 4 lakhs, and you can see that there is a difference of rupees 3,50,000. And from contribution, if we deduct fixed costs, at present there is a loss of rupees 1,50,000, and here if we continue to operate it, and you can see that due to avoiding of fixed costs, our profit is 2 lakhs. So loss of rupees 1,50,000 is now profit of rupees 2 lakh. As a result, you can see that there is a difference of rupees 3,50,000 from loss of rupees 1,50,000 to the profit of 2 lakh. So there is a difference of rupees 3,50,000. So let us conclude the example. From the differential cost analysis, it is clearly seen that due to avoidable fixed cost of rupees 3,50,000, there would be a profit of rupees 2 lakhs instead of the loss of rupees 1,50,000 if the firm operates the plant. Now, next question arises, what should be the minimum level of sales to operate the plant? Friends, so long as the firm is able to generate some contribution, as you are knowing, contribution is nothing but difference between sales and variable costs, it should continue to operate the plant. We may use break-even analysis with a view to determine the minimum level of sales for operating the plant. What is break-even analysis? Break-even analysis means a break-even point is nothing but the point where there is no profit, there is no loss. Here we will take help of break-even analysis. So first we will use the formula for finding minimum level of sales for operating the plant. Here the formula will be fixed cost divided by profit volume ratio, where fixed cost is nothing but present fixed cost minus avoidable fixed cost. So fixed cost will be nothing but here after deducting avoidable fixed cost we will take into account. Profit volume ratio is nothing but it is also known as contribution to sales ratio. So the formula for finding profit volume ratio is contribution divided by sales into 100. Let us extend our previous example. So we are taking the same example, there is no change in our example. There is total fixed cost of rupees 7,50,000. We are going to avoid fixed cost up to rupees 3,50,000, and we are asked to determine the minimum level of sales for operating the plant. Let us have a first calculation. The first calculation will be of minimum level of sales for operating the plant. So here we need two information, fixed cost we need and profit volume ratio we need. Let us make the calculation for the fixed cost first. So here fixed cost for the purpose of the calculation will be fixed cost minus avoidable fixed cost. At present fixed cost is 7,50,000, and as you know we are given that avoidable fixed cost is rupees 3,50,000. So for the purpose of calculation of minimum level of sales to operate the plant, our fixed cost will be rupees 4 lakh. This was one information we need. Now the second information we need is profit volume ratio. The formula for finding profit volume ratio is contribution divided by sales into 100. Contribution is given to us in example itself. Per unit contribution is rupees 10 and per unit selling price is rupees 50. So 10 divided by 50 multiplied by 100, our profit volume ratio is 20%. So we were in need of this two information, fixed cost and profit volume ratio. Now we have both the information. We can calculate minimum level of sales for operating the plant by substituting both the information. Here fixed cost is, as per our calculation, 4 lakh and our PV ratio is 20%. So 4 lakh divided by 20%, our answer is rupees 20 lakhs. So this 20 lakhs is nothing but minimum level of sales to operate the plant. So we can conclude the situation as the present sales is rupees 30 lakhs and the minimum level of sales for operating the plant is rupees 20 lakhs. We can conclude that we can operate the plant till the sales reaches minimum level of sales for operating the plants, that is rupees 20 lakhs. So at present sales are 30 lakhs. We can wait up to rupees 20 lakhs sales, and therefore it is advisable not to shut down the plant. We continue with the operating the plant.
Now friends, let us verify the impact of minimum level of sales on profit so as to take decision whether to operate or shut down the plant. As per our calculation, minimum level of sales is rupees 20 lakhs. So by keeping rupees 20 lakhs in our mind, that is of minimum level of sales, we prepare a statement here. The very first item in the statement will be sales, and that is rupees 20 lakhs. As you know, minimum level of sales for operating the plant has reduced to rupees 20 lakhs from rupees 30 lakhs. Now from sales we deduct variable cost. We have to make calculation for the variable cost, and we have three options for that. The very first option is, here we are given selling price of rupees 50 per unit and variable cost is rupees 40 per unit. So we can say that variable cost is 80% of sales. As you know, sales are rupees 20 lakhs. 80% of that will be 16 lakhs. In this way, variable cost is rupees 16 lakhs. The other option is PV ratio. Friends, as you know, PV ratio is nothing but contribution to sales, which is given in the example, and that is 20%. And hence we can say that variable cost to sales ratio is 80%. And as you know, sales are 20 lakhs, 80% of that will be 16 lakhs. This was the second option. The third option is, we are given sales of rupees 20 lakhs and selling price per unit is rupees 50. So we can say that number of units which are sold are 40,000, and if we multiply variable cost per unit of rupees 40 with 40,000 units, we get variable cost of rupees 16 lakhs. So these are the three different ways of determining variable costs. Now back to our deduction. From sales of rupees 20 lakhs, if we deduct variable cost of rupees 16 lakhs, balance is rupees 4 lakh, which is nothing but our contribution. Now it is time to deduct fixed costs. Fixed cost is rupees 4 lakh. And from contribution, if we deduct fixed cost of rupees 4 lakh, we get profit or loss of rupees 0. And friends, this is nothing but this is our BEP situation. This is the situation where we are having no profit, no loss. So break-even point is the situation where there is no profit, no loss. Hence, the firm can operate the plant till the sales reaches to the break-even point. Means if sales are above break-even point, there will be profit. And if sales are below break-even point, there will be loss. So we can say that the firm can operate the plant till the sales reaches to the break-even point of rupees 20 lakhs. If sales go below rupees 20 lakhs, it will have to shut down the plant. Hence, in this way, we can verify the impact of minimum level of sales for operating the plant.
Let us summarize today's session. Today's session was focusing on one of the various short-term decision-making situations, that is, operate or shut down the plant. I am sure that this has given insight whether to operate the plant or shut down the plant with the help of differential cost analysis. This session will help you to identify relevant cost for decision making. Relevant cost means the cost which is important, which plays an important role in decision making procedure. Here in this situation, avoidable fixed cost is relevant cost, and with the help of differential cost analysis, you can study an impact of avoidable fixed cost on the profit also, so as to take the decision whether to operate the plant or shut down the plant. Moreover, it will also help you to determine the minimum level of sales to operate the plant. And if the sales reduces the minimum level, then it is time to shut down the plant. This is the end of today's session. We will discuss about the other decision making situations which were found in normal course of business in sessions to come. Thanks and have a great time ahead, and wishes for the bright career.